Welcome to EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretta. Today we continue with our basic series and are going to talk about exits. As a reminder, as well as the audio version, you can see a video version on YouTube. So today we are joined by Kealan Doyle, who's a good friend of the podcast, who is the CEO and co-founder of Symvan Capital. Welcome back, Kealan.
Thank you. It's great to be back, Brian.
We had you on solo in episode 79, but you've been a regular member of our year-end panel, so we're really grateful for support that you've given us. But in case anyone has missed any of these, do you want to tell us who Symvan are?
Sure. We founded Symvan in 2018, and we have both EIS and SEIS funds. The principals have worked in technology markets since the 90s, so we're not young spring chickens anymore. But I think that experience is, we were one of the first to come in the market, I think, that with a what was then considered an aggressive target level in terms of IRR, because as you remember, the market was asset backed and much more staid, if you like. But I think the one thing we pride ourselves on is the low failure rate and multiple exits achieved. We've had 6 exits thus far, and we're hoping for another 1 or 2 before the year ends. So let's see, that might be a bit ambitious.
Yes. Well, we always hope. But as you mentioned, exits are something that people are really interested in. And I think partially because for a while we didn't have any. And as we're recording this, I think we're recording this in 2025 and we have seen sort of return to exits. But I think it might be good to frame that about what is an exit and why does it actually matter to investors?
An EIS fund run properly should be for a client portfolio. Depends on the risk appetite of the investor, maybe 5 or 10% of your overall portfolio, but it should be the highest performing part of that portfolio if all goes according to plan. But at the end of the day, it's an illiquid asset class. And oftentimes I say in investment meetings, your house is something that you buy and hold for a long time. So it's not the kind of investment you should make if you are looking for ready access to cash. But exits at the end of the day are the be all and end all. Because if you buy into our fund and we never exit, what are you holding? An illiquid asset? Not really what you want. So you have to have regular exits. And luckily and they do take a while. You should be thinking, we mentioned that the average life, which is a fixed income concept, but we use it anyway, is like 7 years. For a company, but some happened before that, and some happened, a bit after that. We had one last year that I think was 8.5 years, but we had one recently, a group called Custodians, that was the SEIS were 5 years, and the EIS a little less than that. So it's very good. The thing about exits, and you know this, Brian, is that really hard to predict when they happen.
An illiquid share, you're relying on, to some extent, third-party activity. It's not entirely on. The circumstance, we'll come on to different types of exit, and there's one circumstance where it's a little bit under control of the founders, but basically you're waiting for external events. We all like successful ones, but I think we can't get away without mentioning failures, because I think those are part of it. And technically, for people's exits, they sometimes don't mean failures, but actually failures are a form of exit.
Yeah, if you have one great exit and then 9 failures, you might be in positive return territory, but it could be challenging. But failures are an exit, and it's remarkable how many people in the market don't regard a failure as an exit. I think there's different types of exits, and we'll discuss that. But you've got to expect and that's the reason why you get such generous tax relief. Is there in venture capital there are going to be failures. The metric should be looking at cash in and cash out, like what percentage of the money you raise fails. In our case, it's less than 10%, which is pretty good by venture capital standards. Oftentimes people have 50% failure rate or higher, but you can still make money if you get the good return. So, but to ignore failures, from an investor point of view, if you don't understand that there's failures, then you shouldn't be in the asset class.
Yeah. And I think the challenging in EIS is typically failures become before the successes of any given portfolio.
Oftentimes, you make, no matter how much due diligence you do, and we don't think due diligence is a snapshot in time, it's a continual process. But, there's all sorts of different reasons for failure. Sometimes there's no product market fit. Sometimes, with the university spin out, sometimes they're really great ideas, but they're not commercial. There's mismanagement or founders fall apart. There's all sorts of things that are highly unpredictable.
Yeah. But at least in EIS and SEIS, you can get loss relief.
Exactly, which is a big advantage over VCTs.
Yeah, VCTs, I mean, it's not the failures, you're sort of swept up in everything else. So having covered the failures, warning people that kind of exist, let's talk about the sort of successful exits. And I think the most common method of exit is what's known as a trade sale. Do you want to tell us what a trade sale is and how it happens?
Okay. A trade sale is basically where you have an exit where your company is sold to usually another company, often a larger company. In fact, usually a larger company. I'll give you an example of a trade sale. We had a company, Manchester-based, called Custodiex, which is in a very interesting area, which is digital asset custody technology, which if tokenization is going to ever become an institutional product is much needed. And we were a very deep tech play. After many months of negotiation, we sold it to a Dutch company called Amdax. Amdax is a much larger company. Our company had maybe 7 employees, and Amdax is sort of 150 and growing rapidly. So that's very, very typical of, where you sell to someone in a related industry, but you have a little piece of the jigsaw puzzle, if you like, that helps them.
Yeah, and the reasons can vary because sometimes it's adding a feature that they don't already have, or adding a market they don't already have, maybe a foothold in a new market. All the sort of usual reasons that, if you used to quote companies and they're buying, you see all the sort of strategic reasons, and they also happen in this market. It's probably worth mentioning that you can sometimes get shares and sometimes get cash. And the two of them are a little bit different for investors, I think.
They are. So we spent a lot of time in negotiation because the EIS market, one of the peculiarities, and I've been in the Treasury and saying I wish it was eliminated, is the 3-year rule because of the nature of how unpredictable the sales are. But in this case, it's a kind of highly structured exit because the early investors get cash back, and the later investors it's an exit that's going to take another 2.5 years to fully manifest itself because they would have to have a tax event, and they're going to be getting shares in the new company Amdax. And so they'll be in a situation where they're holding Amdax paper, but they've got a tax event, losing, i.e., having to pay back HMRC. And that's not desirable. So it took a while for us because there is no EIS market in the Netherlands, but we got there in the end. So but there's all sorts of, sometimes they're all paper transactions. We had one early on, I think our first exit, it was an all paper transaction. But then this is also with large cap companies. So often M&A involves cash and shares.
Yeah. So sometimes you'll get your cash back, which is great. Sometimes you end up with shares in a listed company, which obviously you can sell. And sometimes you'll end up with shares in another unlisted company. So while theoretically there's a kind of exit, in practice, you don't actually have anything that you can liquidate in the near term.
No, and really, you're hoping that one day there is an exit of the company that buys you. So, for instance, with this company Amdax, they're talking now. I'm looking into it quite seriously about listing on the stock exchange, and that would allow people to have an exit as and when they.
So, the next sort of exit I'd like to talk about is secondary sales. Do you want to tell us what a secondary sale is?
Yeah. Okay. A secondary sale is where, say, for instance, you were holding an unlisted company and wanted to, secondary sale in listed markets is very straightforward. You just, email your broker and trade the shares. But in private equity, and they're more common in private equity, I think, because the deal size is a lot higher. But for smaller unlisted companies, secondary sales are difficult to achieve, and there's a number of people who've been trying to solve this. And I think it's getting there more, but it would allow us to say to an investor, "Hey, there's a bid for two times your money, or make the decision ourselves because we have discretion, and give you a liquidity event without an M&A transaction associated with it."
Yeah, I mean, certainly at the moment, they are more common as part of a funding round. So I see, and I suspect you see, is something similar, is where the next funding round is happening. The investor, for whatever reason, wants more shares than they can get. And they go to existing shareholders and say, okay, you're early shareholders, I'm going to buy them, hopefully at a nice return. And that will supply the exit.
Yeah, absolutely. And sometimes that's if there's a funding round and they're as you say, they want more shares and they're looking to offer existing shareholders, sometimes that can be at the price that the funding round happens. Sometimes it could be a discount.
I mean, certainly, I think from my perspective, 4 or 5 years ago, I was really worried that these secondary sales were strictly a bull market activity and they would just disappear. I'm pleased to say they haven't.
Yeah.
They're still not that common.
No, they're not at our side of the market. There's sort of growth companies out there. They're not as common. But there are people who are trying to, including the London Stock Exchange, and there's various other groups out there trying to solve it for venture. And maybe one day they'll get there, and it would be great. It would increase liquidity for people, and that gives you a lot more options.
We'll see what Pisces brings. And talking of stock exchange, I think, that brings us to the next sort of exit option, which is the one I think lots of people think about initially when they think about exit, which is initial public offering or an IPO.
Yeah. Well, IPOs, there used to be a lot more vibrant market than it is now in the UK. The AIM market, for instance, was considerably more active in the 2000s, vibrant in the 2000s. That has kind of decreased, and there's a number of reasons why. And I know that your company is all over the AIM market doing high quality research, and I think that's needed for the IPOs. But it's funny how very few of because Nick and myself, the other co-founder, we have a strong background in IPOs. I mean, Nick was even involved in Autonomy when they IPO'd way back when, and that became the biggest success story in the UK tech. But most of our founders aren't really looking at the IPO route, or if they are, they're thinking in terms of NASDAQ.
Yeah.
It's a real shame.
NASDAQ seems to be more popular.
Yeah, it's a real shame and then partially that's higher valuations and partially it's just more liquidity. And I guess, it adds to the luster of the company in some cases, particularly if it's a global play.
Yeah. And I think there's different segments of the market find it different tracks. I mean, I think for biotech, the path to AIM, particularly as the next funding round, I think that is still open for quite a few, but for your average technology company, it's perhaps less clear.
Yeah, I would agree with that.
Yeah. So they're kind of the main sort of exit routes. What else should investors look out for when sort of looking at exits or thinking about exits?
Well, I think the timing is important, and that's why it would be nice if there was an IPO market or an active secondary market, because sometimes if investors are in something, if they have an exit in 5 or 6 or 7 years, that's fine. But if they're in like 12 or 15 years, it would be nice to have an exit. One starts getting a bit impatient. And, institutional VC funds tend to have a life of 10 years, but with a possible to extend it to 12. Although there are variations on that. So I think the timing and, when looking at a company or looking at a fund manager who manages that, you want to see some clear track record of you're not waiting forever to get your money back. I think also on the opposite end of the spectrum, which I just alluded to with the Custodiax trade, sometimes if you're a fund manager like us who invests over time and not just one lump of money, you find that some people are constrained by the 3-year rule. And we mentioned this earlier. But that's important. I mean, that was one of the main considerations we were looking at is we don't want people to have a tax bill. That's important. But of course, after the 3-year rule, all the upside's tax-free in the EIS market and SCIS market. So, that's an important consideration because anybody who says that, you shouldn't be looking at the tax relief, well, it's ridiculous because it is an essential part of your return. So your after-tax return is really, I mean, you will have a tax if you sell a listed stock, but if you sell an EIS, it's tax-free. Well, that just enhances the appeal if you get it right.
Yeah. I think the other point I would say on the early exits is that if you get a really good early exit, so if you get a 2 times return or a 3 times return on an early exit, who cares if you return? If you got to return the income tax, and I've seen people sort of take that attitude.
Yeah. And that makes sense. But then you've got to weigh that against the number of failures in a portfolio.
Yeah. I mean, if you gain 1.2 times, it's very different. So if anyone wants to find out more about what you're doing at Symvan, where should they go?
They can go to symvancapital.com and our website. And there's all sorts of information there as to, well, exits is one of the topics, but also just what our in general investment style is and what kind of things we invest in. Because when you're looking, I mean, I think these funds should be seen as part of a broader portfolio. So I think it's essential to have some understanding of what the fund manager is looking at, what sector, because you don't want to just be overweight, consumer tech or something. You want to sort of blend there. So they can find all that out on our website.
Great. Okay. Well, thank you very much for coming on today, Kealan. Really appreciate your support for the podcast over the years. And thanks for coming on today and talking about exits.
Hey, thank you very much, Brian.
So for listeners and viewers, as usual, you can get full show notes with links at harmonandco.com/podcast. You can subscribe to the podcast on all good podcast services and players, or following the link in show notes, or you can subscribe to the series on YouTube. If you like what you hear, then please tell a friend or colleague, or give us a review on your favorite podcast app, or you can give us a like on YouTube. We can be contacted at inquiries@harmonandco.com. Thanks for listening. And I think this will be the last in the series, so we'll be back to our normal programming very soon.